What's up, everybody? Bottoms up. What's good? What's good? Thursday night. Stocks on the rocks. What is going on, everybody? Man, need that today. I don't know if it's good for me or not, but I will tell you this. It's great to see everybody here on our every other Thursday. Stocks on the rocks. I will say this. I don't know if that's good for me to be having that, but can't hurt, I don't think. You can hear that I'm a little stuffy. I've got a little stuffiness, head cold going on. Not too much else. Everything else feels fine. But I don't know if it's sinuses or what, but figure try to kick it with some tequila, right? Why not? So what's up, everybody? It is our Thursday night session where we can talk about anything and everything trading and investing. And for those of you who are joining us for the first time, this is our Stocks on the Rock series where we do it every other Thursday at this same time. We have a cocktail or not. You don't have to have a cocktail, but many of us do. It's a little happy hour. Happy hour as we approach the end of the week. Specifically this week, it is the end of the week. The markets are closed tomorrow for Good Friday. It is Easter weekend. So today is our Friday. And so we are ending the week, the trading week, with some stocks on the rocks. So this is a session designed to be full on guided and directed by you guys. I come prepared with absolutely nothing to talk about. I talk all the time in our training rooms. I talk all the time, and anytime we have instructor or mentor driven webinars, this is a time for you guys to get your questions answered. Whatever's burning a hole in your brain that just needs to get answered. You want to talk about, you want to banter. Even if it's not about trading, we can talk about whatever you guys want. We have an hour. And if you guys run out of questions, which I highly doubt is going to be the case, if you guys run out of questions, then I'll give you your Thursday night back. We don't have to hang out the whole hour. But many times we're here the whole hour, and I'm totally fine with that. I am going to post a recording. I recently started posting the recordings on YouTube. So if you go to our YouTube page, find us on YouTube, like and subscribe, all that good stuff. You can get notifications when I post the new Stocks on the Rocks every other week. And that's for people who can't make it live. And if you have any questions when you're watching back of the recording, ask away. I'll try to do my best to watch the YouTube comments. Or you can email us directly at support@tradersarmy.com. So not much else to really talk about there. It's good to see some familiar names in the chat box and also some new names. So welcome, possibly for the very first time. The one thing that I will say housekeeping wise, because we open this up to anybody and everybody. We've had situations where in the past, I just have to say this every time, we've had situations in the past where we go live on YouTube or we promote, come on, anybody's welcome. And people unmute their mic or turn their video on, and there is just the most inappropriate, childish stuff you could possibly imagine. Not childish, sometimes childish, that's fine, but very inappropriate. So let's not do that, okay? Don't need to ruin the fun for everybody. So what I did is I actually turned starting your video off. I feel like I know everybody in the room here, so if we want to turn videos on, we probably can, but it only takes one to ruin it for everybody. So if you want to turn your video camera on and you want to be appropriate, feel free. It's nice to see people. It's lonely in my studio. Trading is lonely, so it's great to have a community that you can see. If you don't want to turn your camera on or you don't have one, also good. If you want to use your microphone because it's just easier for you to talk through your question versus type it in the chat box, be my guest. Just let me know. Say, hey, I want a microphone. Can you let me have the mic for a second? And we'll go ahead and do that. Mark, good to see you, buddy. How you doing? Got a little library back there. I like it.
Doing great.
Awesome. All right, so text
Corey,
Yeah.
one thing you might consider is letting people raise their hand.
Sure. Yeah.
in the chat, I think there's a way of doing that, or hit a option Y on Apple. I think it's Alt Y on
Oh, great.
system. Um,
Yeah. So it looks like,
what it does, if anybody does that, it moves them right to the front of the line.
oh, that's great. Yeah, it looks like under so in your little Zoom dashboard, your little Zoom button where you turn your audio and video on and off and share screen and all that,
Yeah,
you have it's called React, right? So if you hit React, there's a raise hand and then a little hand will go up. I just put mine up right now. So
yeah, something like
no,
that. Yeah.
that's fantastic. So lower hand. That's great. That's good advice, Mark. Thank you for that.
I'll free of charge.
I love it. Free of charge. The next one's on me. What you got there, Mark? What are you sipping on?
Just a fine bourbon in a Tony's on the pier glass.
I love it. I love it. I've got a Blanco tequila in a Trader's Army
Ooh, a
glass.
TA. Yeah.
That's right. Anybody interested in some Trader's Army? We got a dual pack going on. I should probably put them on sale because it is spring and it's Easter and all that stuff. Um, but we got them on merch on the site. So there we go. So a little shameless plug there. I like it. Little bourbon. I like it. All right. So Tex asks, today you mentioned assignment calculations. I've been assigned a few and I'd like to know more. So Tex, what do you mean assignment calculations? So if you mean there are times where I get assigned early and I didn't want to be assigned, maybe this is what you're talking about. I didn't want to be assigned necessarily, but I got assigned and I'm like, ah, shucks. I don't want to be assigned. Let me roll back into some puts and sell the shares and roll back into some put options and go out another month or 2 months or however. Is that what you mean, Tex? Is that what you're talking about? Yes. Okay. So I'm going to share my screen and I'll do this. I'll bring up Thinkorswim. So I'll give you a let's see, do I have an example? Let's just say what will be an example? Let's just say that I took example because I rolled these earlier. We did these in class. That I was interested in not interested in owning tech, right? So tech, TECK at 36. Stock closed today at 32.91. But let's say that earlier in the week I was assigned on these shares. And now I own 600 shares of tech, let's just say, because I've been short 6 shares. So let me hide my existing positions and say that, oh, I got assigned 600 shares of tech. And the price was my strike price, which was 36. Okay. Now, if I got assigned, obviously you won't know that you're getting assigned until you're assigned, right? The person who owns the option can assign their options, can exercise them anytime they want between the time you enter the position and expiration. And so on an American style option, which is all stocks and all ETFs, the assignment is possible anytime between now and expiration or entry and expiration. And so if an option goes deep enough in the money before expiration, it becomes more likely that you're going to get assigned. And I've been assigned many times early. And sometimes I'm like, okay, that's fine. And sometimes I'm like, no, I don't want to be assigned. And so what are my choices? If I didn't want to be assigned and I got assigned, I could sell the stock and just say, I'm done. I don't want the stock, take the loss, move on. But what if I thought that given a little bit more time, another week or two, or a month, or another 2 months, that I thought that this stock could get back above 36 and I wanted to roll back into puts. Okay. What I've done is I created a calculator for that. And the calculator for that is in the Wealth Essentials portfolio. And I've just added it to the, so if you didn't notice this morning in the trading room, I actually added the roll shares back into short puts tab in the downloadable Wealth Essentials portfolio so you can use that for your own trading. And so what this does is this lets us say, okay, stock, I was assigned shares of tech, 600 shares at $36. And now the stock is trading for 32.91. This tells me that I'm down $3.09 per share. This calculator that I built tells me I'm $3.09 down per share. On my 600 contracts, that's almost $1,900. Now, if I want to roll back into another short put or a put spread, that's when I go into columns I through O. And I'll say, okay, and this would be the case if earnings weren't coming up, Tex, but earnings are coming up, so I rolled into a put spread. But let's pretend for a second that prices are not coming, the earnings is not coming around. And I say, you know what? I just want some more time. I think the stock is going to be above 36. I think this thing is trying to maybe find some support here and it's trying to move off these lows. Maybe I need another week. So I'll go to April 25th and I'll look at the 36s. I'll say, how much are those paying me? Now, remember, I'm down 309. So if I'm going to try to roll for a credit, which is what I always try to do, roll for a credit, close my current position for a loss, open the new position for a net credit. I need to get at least 309 because that's what I'm down in the shares. And so if I look at the 36s, I can get 310 at the bid, 370 at the ask. I'm probably getting somewhere around 330. 330 is probably a fair price, 330, just to roll out 1 week. And so I could say, okay, if I'm going out 425 and I'm going to stay at 36 and I'm getting $3.30, I can keep the same 6 contracts and I can basically roll back into the 36 puts that I just got assigned on that did expire, that were about to expire April 17th, and I got assigned on them, but I don't want the assignment. I can roll that back out and get $126 credit and roll back into short puts. So what does that mean? That means I got to sell my stock for a loss. That's good for a tax write-off too, by the way. And roll back into some 36 puts at 330 a share, 6 contracts, and bring in $126 net credit after recouping my losses on the shares themselves. Okay. They might say, well, 36 is cool if I want to stay at the same price, but what if I actually want to try to roll down? Well, if I want to roll down to say the 35s, I'm not getting, well, the spreads are enormous here, so it's hard to tell what you're going to actually get for those. But let's say you're willing to go out to May 16th and say, okay, well, I'm going to go down to the 35s, right? These are tighter spreads. I could probably get somewhere around 330, 340. Not about the same price. You probably get about the same price. I don't know why I would go out 29 days when I can go out 8 days and get the same premium. But if you were to go out a little bit further, you might be able to get a little bit more premium and therefore collect a larger net credit. And this is usually what I like to do when I don't want the dollar for dollar delta. That's the difference between staying long the shares. I'm 600 deltas long, okay, versus if I were to roll back into the 8-day 36 puts, 6 contracts, okay, 600 deltas long on the shares themselves, $1 per share I own, versus roll back into the 36 puts 1 week out, I reduce my delta exposure from 600 to 482. Now, why is that important? Because I don't necessarily always want to be as delta exposed if the market's going to move against me. And so that would be the biggest motivation for me trying to roll back into puts is to reduce my delta back to a delta of less than 1. Does that make sense, Tex?
Yeah, can you hear me? I went video and audio.
I love it. We got a
Okay.
visitor on camera and audio. I love it.
Yay, yay.
Welcome to the party,
First
Tex.
time for me doing this.
I know it's a big move for you. That's awesome.
Yeah. So I see you have a firm on the on your WE portfolio. I was also assigned a firm, And rather than sell the stock and sell more puts, I just kept the stock and started and sold covered calls. I
Also,
didn't get enough in the money. I didn't get enough of the money from selling the covered calls to make up the difference exactly, because you got earnings coming up on 5/8.
yep.
But I figured I sold the 425 covered calls. If they're not assigned, I'll sell covered calls again until earnings
Yeah.
and see what happens.
Yeah. And I'll usually do two bits of analysis before I decide to keep the shares or roll them back into puts. Is, can I get a better premium by selling covered calls at my short strike at my assigned price? Or can I get a better premium rolling back into short puts? And sometimes it's a very obvious, oh, I'll get way more premium for selling covered calls. And then I'll just keep the shares and sell covered calls like you did.
Yeah.
But if it's more premium to sell the shares and roll back into puts and take on less delta, then it's usually very obvious, a little bit, a pretty big difference. If there is no difference, then just keep the shares and sell covered calls.
What did you do?
For a firm, I have the shares. I have not sold covered calls because when I got assigned the shares, there was no premium at 52, which is my assignment price. I think that's my assignment price on a firm.
Mine was, I think, 55. I think I'd have to double check that.
Wait, was I assigned on a firm? I think I was, right?
Yeah, it's in your wealth portfolio. 200 shares. Assigned cost 55, same as me.
Yeah. Hold on a second, though. A firm. Oh, rolled back into the 52 puts.
Oh,
For
okay.
expiration. Yeah, so I put a note over here. Rolled back into 52 puts. So I rolled down and increased size.
Oh, okay. That's something you
So,
can do too that I hadn't figured out before. I learned that a few weeks ago from you.
right.
Um,
So check this out. So here, a firm 255. Here's the paper trail on this one. When I got assigned, the stock was at 48.31. So what I did is I rolled back into the 4-4 expiration 52 strike for $5 in premium, which did not make up the $6.69 that I was down on the shares. So I had to bump my 200 shares or two contracts that I was assigned on up to three contracts in order to maintain that net credit. And in this case, I got $165 in credit. So I not only rolled out, I rolled back into puts, I rolled down and increased size a little bit. So that's what I'm in now. So I need to show all positions, and now I'm in 300 shares of a firm, so I got assigned again. Now I'm at 52. So if I look here at 52, there's no premium for 8 days. If I go out to May 16th, 52s, there's not even 52s, but there's a lot of premium at the 52.50. Right? A lot of premium. That means that earnings are probably coming up soon. Earnings are on 5/8. So in a perfect world, May 2nd, 52s, they're paying something, but not a lot. So I would do the analysis at this point, and I might also use like a stock repair. So instead of going 52, I might try to lower the break even to 50. It's trying to rally. Let's see if we can lower the break even to 50. So I'll sell 6 of those. If I sell 6 contracts against 300 shares, I'm naked on 3, right? So because I'm $2 below my cost basis, I'm going to go out $2 below 50. I'll go to 48 and buy one of those. And I'll buy 3 of those. And I'll get a 2-cent credit. Now what happens is I'm basically in a covered call and a bull call spread. This is called a stock repair strategy. Right? So I'm trying to lower my break even to 50, which I can successfully do. If I can get filled for a $2 credit, that means that if the price rallies above 50, I can get out for a profit of $6. Three contracts times $2 a contract. I get out for a profit of $6. Woohoo! That's amazing. That's awesome. Except I don't care about it being an awesome credit. What do I care about? I care about taking my break even from 52 down to 50. And now my exit price doesn't need to be above 52. My exit price needs to be above 50. So if I can lower that break even price by doing a stock repair, covered call plus a bull call spread, then I can lower my exit point to 50. You ever watch the webinar on that one, Tex, that I did?
No, I haven't.
Oh, goodness. That's going to be a good one for you. You should check this out. I'll show you where you can find it.
Yeah,
So,
fine. Tell me where.
yeah, so go into your Traders Army dashboard. Let's go to Traders Army. I must have closed it on accident. So let me go to Traders Army. Let's go into your pro member community lobby. I find that I thought this was going to be I guess when I build things, I think things are more in an obvious place than they are. But right at the top of your community lobby, portfolio protection and stock repair strategy clinic, right here. Big red button. But for some reason, that gets overlooked often. I don't know a better place to put it though. But yeah.
Okay, so that's the webinar.
That's the webinar. And then if you view the recording, I'll give you a little hint here. So the first portion of it is all like hedging using puts, delta hedging, portfolio hedging. But if you come down here to my chapter menu, can you see where I'm hovering where it says chapters, like a little hamburger menu? Just go straight to stock repair strategy. Oops. And that'll take you to 2 hours and 8 minutes in.
All right.
And I go into stock repair strategy, which is basically combining a long stock position, a covered call, and a bull call spread in an attempt to lower your exit or break even point on the whole trade for that expiration window without spending any money.
Awesome. Okay, I'm going to take some time over the weekend and watch that.
Yeah. So basically how this works in a nutshell is we're selling a covered call at 50. So imagine, Tex, if I just come in and I sell a covered call at 50, right? That means that I'm 3 contracts. I'm guaranteed to lose $513 because my cost basis is 52. So I'm guaranteed to lose $2 a share on the stock if I'm obligated to sell the stock for 50. Would you agree with that?
Yeah.
Great. So how do I get this? How do I get this little pumped up, so I can get my break even at 50? Well, I basically buy a 3 contract 48 by 50, 3 contracts, bull call spread that cost me 30 cents. And in the event that the stock is above 50, how much does this $2 wide spread make if I pay 30 cents for it? So the best case scenario is $2. I make $2.
Right.
I pay 30 cents, which means best case scenario, if the stock is above 50, I make
170.
I make 170. So what happens is if I combine the 170 I make on the bull call spread with the premium that I make on the short call for the covered call, I can get out at break even above 50. And you see how this is not a normal covered call, how it has a diagonal line. And then once it gets to 48, it has this little kicker, like a little ramp, almost a little jump ramp. You see that?
Yeah.
That's the bull call spread. So what I'm losing by selling the stock for 50, I'm going to make up by my maximum profit potential in the bull call spread.
That's awesome.
It's crazy. It's crazy.
It's crazy, but it's awesome.
It's crazy cool.
I do the very simple stuff of just selling, covered calls, hoping that I can get enough over time to cover the difference.
Yeah.
Like I did with a firm. I'm going to get assigned today I had 155 put on Google, but I want to own it in this particular account that I don't own it in that account.
Okay.
But I got like $5 for selling the put. So my cost basis is 150. So I'm in great shape on that one.
Right. And and that's fantastic. I'm not even considering the premium that I got for rolling and selling the affirmed puts. and getting a
Oh, you're not including that.
I'm not including that. This has nothing to do with that. This is assuming that I'm out at 52, that I own the stock at 52, not including all the premiums that I sold and rolled for the selling the puts. If I wanted to include that, I would lower my break even more by doing this.
Yeah. So why don't you do that?
Because I don't want those short puts to be for nothing.
Okay.
That's it. I don't want me selling puts and rolling the puts to be for nothing.
All right.
Do you know what I
I
mean?
got you. Yep.
It's there's no wrong answer there. But I'm looking to get out at break even plus, if you will,
I got you.
right? Plus the premium. And so the stock repair, when you build this in one position, it's however many shares you own. And right now I'm attempting to drop the break even price to 50, right? So let's start at 51 real quick. So if I sell the 51 puts, you're going to sell calls. You're going to sell twice as many calls as shares that you own, which is going to leave you naked on 3 contracts, right? You're selling 6 calls against 300.
Yeah. Right.
Right?
So
Now
you're
you're
naked
naked.
calls. Yeah.
So now you're selling 3 naked calls, 3 covered, 3 naked. So how do you make sure you're not naked? Well, your assignment price of 52 minus your new break even of 51 you're trying to attempt is you need to make up $1 somewhere. So now I'm going to go $1 further in the money and buy the 49s, the exact same amount of contracts that I'm naked on. I'm going to buy 3 contracts, so now I'm not naked. I have 300 shares of stock that'll cover 3 calls that I'm short, and 3 calls that'll cover 3 shares that I'm short. And now I'm moving my break even down to 51. Now the question is can I move my break even further? So if I sell the 50 calls, 6 contracts, how much would I lose on the shares if I were obligated to sell the shares at 50? I'd lose $2, which means I need a $2 bull call, Tex. I need a $2 bull call. So now I got to go to the 48s and I got to buy those because that's a $2 bull call. 3 contracts, not 31, 3. And now I've got a $2 bull call to make up for my $2 loss on the shares.
Right.
And now I'm going to try this one step further. Can I get my break even down to 49? I don't know. The answer is yes, but I'm going to sell 6 of those. And now how much would I lose? I'd lose $3 on the stock, which means I need to make up $3 on the bull call. So now 49, 46 would be my long strike. 3 of those. And now I got to pay a debit. So for me, the key is don't pay for the stock repair. Get a credit or break even. Because right now, if the stock is above 49, I'm guaranteed to lose $51 because I'm paying a debit for this. So there's a limit to how low you can get your break even in a stock repair strategy. And so I'll go down as far as I can, not pay a debit. And so I think at this point, yeah, your break even is 49 or above. And maybe that's more interesting to you. Maybe you just want to be out at 49 and you don't mind paying $50 to be out at 49. Maybe you don't mind that. It's pretty inexpensive to bring your break even down from 50
Right.
to 49, but that's your call, right? So
Right.
I'd like to do maybe 48, I'm sorry, what was it? 40, or I say 40, I'm sorry, 50 by 48. Right? And then if that doesn't work for May 2nd, then I'll do it again. And just keep doing it until the stock repair works.
Yeah. All right. Got it.
Awesome.
Yeah. There's that, all of those calculations and everything, or you win some, you lose some. Sometimes you sell
Also
stock
true.
and you take a loss.
Right. Also, sometimes taking the loss is nice. But check this out. I have calculators for everything, Tex.
Yeah.
I got a calculator for stock repair.
Oh, okay. So that's in
This is
there also.
stock holdings, covered calls, and stock repair. It's all in the
Got
same.
it. All right,
So
great.
I got here's the stock that I might own, covered call positions, and
All
stock repair.
right.
I got
All right.
calculators for everything, Tex.
Thank you very much, Corey.
I
This
do
is
not.
very
Good,
good.
good. Yeah, I
All
don't like
right.
doing math, so I need calculator. I need to be able to act quickly, and so calculators, spreadsheets are great for me. I love them.
That's great.
Good, good. All right. Let's go back up to questions here. Ken says, have I used the TradingView options interface? I have not. I don't have a TradingView subscription, Ken, so I don't know if I would even get full access to that, but I have not. And I don't really find that I need to, because I get a fantastic options interface in Thinkorswim. But I have not used the one in TradingView personally. D-Soap, what's up? B-Germ, how you doing? Is everything credit trade now, or are debit trades still around? Well, a debit trade I haven't entered a debit position in a few weeks, just because of the way that the S&P has been behaving. I'm going to use the SPX because I don't want to delete all my lines here. I just want to make it, very clear that when I go down and I look at the SPX, the reason I'm not doing any debit trades is because I can't count on the market moving in any one direction for a long period of time. And for me, a long period of time is a week. And so what's happening here is you're getting this pinching. You guys can probably already see what I'm about to draw. And so the S&P is pinching. Yes, it's creating higher swing lows. Yes, it's creating lower swing highs. And this symmetrical triangle is creating an environment where the risk reward just doesn't make a lot of sense in a lot of the trades, because as soon as the market turns, it takes away all potential profit in a directional trade. So I just don't believe in a lot of directional trades at this point. Not saying if I didn't see one that I wouldn't take it, but non-directionals for me have been paying off better than directionals right now. So I'm still leaning more towards credit trades than not. And they seem to be working okay right now. D-Soap, how can we scan for big blocks or big volume for trade ideas? Well, I mean, I have my one scanner that I look at that scans out all my stocks that are optionable. But my guess is, and I'm just guessing here a little bit, that there's scanners built in. I use Thinkorswim for scanning. My guess is you could probably create a watch list and public watch lists. I'm looking for any sort of big volume. Let's see, active on social, by industry, top 10 active. That would be volume. Top 10 active. NYSE, NASDAQ. Another thing you could do is when you actually go into your volume, like I built a scan in here, like I look at average volume that is greater than 800,000 over the last 50 days. You could modify that to look for current volume, not average volume, but current volume, greater than a certain number. And then that would produce an entirely different set of stocks. So you could do something like that. FinViz is another place that has some pretty decent scans. Oh, screener. There we go. Let's look at all. I'm thinking there's probably got to be some volume scans in here. I haven't used this scanner in a long time. Average volume, all-time high. No, we don't want average volume. You want now volume. Relative volume, no. Current volume, I mean, here's one. So you can kind of mess around with the current volume and scan that way. BGRM asks, is there double risk when you roll the put if the direction goes against you? You are risking more, that's for sure. So if you were to say roll tech, right? let's go back to the daily chart here. For instance, so if I were to roll from the 36s out to the 36s, I've realized a loss for the current position. If I roll out to the 36s for the next month and prices keep falling, then there's more potential loss because I'm still in the position. Remember, you're still just selling puts. Okay. If prices rally above 36, then you regain all that you lost on the first trade, plus your original credit, plus any net credit you received for the roll. Okay. And the reason I'm such a believer in rolling is because, and many of you have heard this in the trading rooms, but Chuck and I and one of our other partners, John, we run a hedge fund, and the primary strategy in the hedge fund right now has been selling short puts. And we did some analysis on over 500 trades. And what we did and what we found, because we tracked like 45 different data points on 500 different trades, and we grabbed the very relevant information into a spreadsheet, shoved it into ChatGPT, and said, what can you tell us about this particular trading strategy in the portfolio and results? And just at a high level, first question out of the gate. Well, seems to be like a really great high probability trading strategy. Tell us more. Well, 71% of your short puts never go in the money, which means they expire worthless. So 71% of our trades never get in trouble. Of the 12.8% of positions that go in the money, they come out of the money by the time expiration, the initial expiration rolls around. So that puts us at 82.8% of our trades never require management. Now, the 17% that do require management, we asked, okay, how quickly do those options eventually become out of the money again? The original strike, not even rolling down, the original strike. So this is, if we're short the 36s, we just stay at 36. And what was interesting is it told us that, well, some of the trades come out within a day or two. Some of them take 2 months. Some of them have taken, up to 101 days. That's the longest, 101 days to become out of the money again. So what that tells us is anywhere between 1 day and about 3 months, if we roll the puts just out, don't even roll down, that 99% of our trades rescue themselves just by continuing to roll out, which is why I'm such a big believer in rolling. Even though short term, it may look a little gut-wrenching if the stock is down here at 25 and we need it to be back above 36, right? It's a hard pill to be looking at, oh my gosh, the stock is at 25. It's never going to get above 36, but you'd be surprised to know that more times than not, the stock gets about above 36, and it might have taken 2 months, it might have taken 3 months. So you're rolling out month over month over month. But that's why I'm such a believer in rolling. Now, if I can roll down and if I can roll out and down without substantially increasing risk, we like to do that too. This way, if we can roll down to 35 or 34, that's less the market has to rally in order to get back out of the money and close the position. But if price keeps falling, you are continuing to carry the risk all the way down to zero. That is the downside of selling put options, right? That is the downside. If the stock goes to zero and keeps falling and doesn't ever rally, you're taking that heat just like owning the shares. So you got to always remember, when you sell puts, maybe not delta for delta, but it is you're responsible for owning the shares at those short puts. And then, Jim, the idea is that you aren't going to lose on this trade. Well, yes, that's the idea, is that if you roll enough times out and down, that you can eventually see this thing through and not technically take a loss, even though every time you roll, you close a losing trade, open up a new one, which looks to recapture all the losses that you just took, realized, plus the original credit, plus any additional credit as you're in the trade for a little longer now. So that's the goal. Then he says, can you show us how to insert the roll share to short puts column if the shares get assigned again and do it all over? Not sure what you mean by that, Denny. Not sure what you mean by that. So what I do here is I would use and I haven't used this very well, to be honest, in the Wealth Essentials portfolio. But if I get assigned the shares and I want to roll back into puts, I'm going to go tech 636 long, current price 32.91. So if I'm going to roll back into the 36 puts for 330, I'm going to gain this credit. So that's going to be my new position in the short puts for May. So that's going to be a brand new position for May. Now, what I also want to do is I want to come over here and say tech in my stock holdings, assignment date, let's say it was April 14th. Was it 600 shares or 300 shares? I forget what it was. Our example here. 600 shares for 36. And stock sale date 4/17. Let's say and then I sold it at 32.91 and the position is closed. It's going to show me my loss in stock. And then I'm going to go over here to my put spreads and I'm going to add the new position, tech, short puts, 5/16, new credit. And I'm going to come over here and I'm going to put in this, if rolled, what is my net credit? And I would grab that from here. Net credit, $126. So I'm keeping track of everything somewhere. I just got 3 or 4 different spreadsheets to do it all. Does that make sense, Teddy? Is that what you were asking? Oh, Tex had to run. I didn't even see him say goodbye. I was focusing on the above questions. Sorry, Tex. I think that's what you were asking, though. So there's just a few different spreadsheets for tracking each individual type position. Now, if you're like, I hate spreadsheets, I don't want to do it, just go use TradesViz or TraderSync and just do it all in there. You don't need to use spreadsheets, but I like the spreadsheet calculators. So no question, I rely on these calculators to help efficiently calculate which makes more sense, right? Rolling back into puts, doing covered calls, stock repair. So yeah, if we get assigned and do it all over, like roll back into puts, right, Debbie? That's this spreadsheet. And I don't know if you caught it this morning, but that is a downloadable. That is now downloadable. I updated it this week. I was so sick this week, but I did it anyway. Teasing. Got a head cold. So it's been updated. So if you download the Wealth Essentials Portfolio Tracker from the Pro Member Community Lobby downloads page, if you load it up, give it a second, because Excel. I've added it right here. Stock rolling back into short puts. So now you have it. And just follow the columns. Whatever the column says to put in there, put it in there. And then the purple columns are the result. So we're going for net credit, just like if we were rolling puts. It's no different than rolling puts. You're closing your short puts for a loss to reopen new puts for a net credit. This is the same thing. You're closing your long stock and opening new short puts for a net credit. It's no different. I just had to create a new sheet because, long shares is a little bit different than short puts on the initial position. Does that make sense? Jason says, on Tasty Trade, one of the main watch lists is all about volume, both for underlying and options. I would think other platforms have it. It's possible. I don't use volume scans as much. Why don't I use volume scans or open interest scans to know where all the open interest is? Because for one thing, volume, let's think about this for a second. Why do prices rally? Is it because of filled orders or unfilled orders? Unfilled buy and sell orders or filled buy and sell orders? Why do prices move at all? Jason says filled. Anybody else? Anybody else? So we're talking filled orders versus unfilled orders. Why do prices move? Okay. Ooh, Daddy says unfilled. Jim and Jason say filled. All right, so check this out. It's going to be pretty sloppy, but on your screen, I want you to watch this. Let's say that on the left, you have your buy orders, and I'm writing with a mouse, which is why it's going to make this sloppy. And on the right, you have your sell orders. These are your bids and offers, right? And let's say on the buy side, would you say that 10 million shares is a lot of, like if this stock had 10 million shares worth of filled orders today, would you say that was a lot? 10 million shares on any particular stock. Maybe not SPY, but yeah, I would say that's a pretty decent amount of shares. So 10 million orders were placed on the buy side, okay, to buy, and 10 million orders to sell on the sell side. Now, if they're all at market or limit prices around current price, if you got 10 million buyers and 10 million sellers, what's happening to all of these orders? Are they going to fill or are they going to remain unfilled? 10 million on the sell side, 10 million on the buy side. Are they going to be filled or unfilled? They're going to be filled. Fill the sellers, fill the buyers, right? No more buyers, no more sellers. Where does price go from here? Jim says nowhere, and you would be right. Nowhere. Why? Because we have balance. That's right, Jason. It just sits there. So filled orders, if you got 10 million on the buy side, 10 million on the sell side, filled orders don't cause price to move. Does that make sense? Because we have balance. 10 million buyers says, yeah, that's a fair price. 10 million sellers, yeah, that's a fair price. And if it's a fair price, price is going to sit there. Okay. Now, let's go back a second. And let's say we have 10 million on the buy side, 5 million on the sell side. Now, we've got twice as many buyers than we do sellers, which means what's going to happen when these 5 million orders gets filled, the buy side is still going to have 5 million left. Would you agree with that? And the sell side is going to have none left. And when you have buyers without sellers, can price sit there? Or does it have to go somewhere? And if it has to go somewhere, which way does price have to go? John and Stephen both say price has to go up. And by the way, I would agree with you. It's not even that price can go up. Price has to go up because we have an imbalance in the supply demand equation. Right? It's the law of supply and demand, right? And the inverse would be true if we had 10 million on the buy side and 15 million on the sell side. These 10 million would get their orders filled from these 10 million, and you'd have 5 million left on the sell side, and price would have to go down. That's just the law of supply and demand. So when I ask the question, do filled orders move prices or do unfilled orders move prices? Which is it? Let's revisit that question again. You're right. Unfilled orders move prices. So we have this unfilled supply-demand imbalance that causes prices to move. So I don't really look at volume as a fantastic indicator of anything because volume is filled orders. That's all it tells me is how many orders got filled. It doesn't tell me how many orders are unfilled. It tells me how many orders were filled. So I look at volume as a way to just judge overall liquidity, right? Judge liquidity. And so, I mean, there probably are some indications, using like market profile, volume at price, things like that. But I would argue that if you see a big spike in price, a big spike that had You know, little volume, 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 little volume. I mean, even if this were big volume, big volume, big volume, big volume, big volume, big volume, bunch of big volume. You see the initial spike. I would want to see low volume on a big spike if I could see it. Because if I saw a big spike with low volume, that tells me there's how much demand left, a little or a lot. If we're talking about specific time and price. Low volume, big rally or big drop, there's a lot of unfilled inventory there, which means when price gets back to that area, that inventory is going to want to be filled. And that area is going to act as a magnet for a price reversal with all that unfilled volume, without all those unfilled orders down there, because there wasn't enough of the other side to fill it. Right. And so I generally, there probably are lots of volume scans, but I feel like I got this suspicion that volume scans are the opposite of what we want to look for. Right. Open interest. People ask me, oh, can I use open interest to gauge direction on an option? Not really, because open interest, for every contract open from a seller's perspective, there's a buyer there too, right? And that's just one buyer, one seller. Now you have an open contract. Yeah, but the more open interest, doesn't that mean that more people are interested in those options? Maybe interested in selling them or buying them. The initiating party, do they want to sell those calls above current price, or do they want to buy those calls above current price? Well, I don't know exactly. Do you know if they wanted to sell them because they were long stock and they thought the price was going to go there and they were selling covered calls? Or did they go long stock? Did they go long those calls out of the money because they're short the stock and those long calls are a hedge? Oh, I don't know. Right. So I feel like always focusing on volume and open interest in these things, it's more of a distraction from what's really going on. So I've always just focused on price, and my volume scans and my open interest scans really just filter out stocks that don't have a lot of volume overall, just in general, right? Because if stocks don't have a lot of volume, the options aren't going to have a lot of volume, the option spreads are going to be wide, and it's just going to be very low liquidity and very difficult to trade. So I don't tend to, I'm not saying it's wrong. I mean, I could be way off base here, but I have this sneaking suspicion that volume and open interest and always scanning for what's going on in the past, which is all filled, it's the only reason it shows up as volume, is irrelevant and a distraction from what's going on right now. That's just my hunch, right? I mean, it served me well so far, um, but that's why I don't know that those types of scans have any real value. And I could be dead wrong. I have no idea. And I'm really happy to say I have no idea when I really don't have an idea. Right. It's just my findings so far. But does all that make sense? Right? Is that kind of that's kind of where that's my school of thought for volume, is that unfilled orders can't show up. Now, to your question, do level 2 showed unfilled buy orders? They're supposed to. They're supposed to, right? So, TradeStation, Interactive Brokers, these are like professional platforms. And what is really unfortunate, and Thinkorswim doesn't let you do it, I don't think, but professional platforms, institutional platforms, they will let you do this. They will let you say, oh, let me place 10,000 or 100,000 shares, right? 100,000 shares to buy at X price. Now, level 2, that could be below current price. Okay. But then on the other side of that, they can have an order to sell 200,000 shares at the same price, which would indicate a supply demand imbalance to the sell side, not the buy side. Would you agree with that? Same price. 200 on the sell side, 100 on the buy side. Same institution, by the way, could be doing this. Which means if that's true, prices will have to go where? Prices will have to go where? That's right, beat them down. right? That's right, Daddy, down. But now, instead of showing all 200, they can hide the entire order. So it doesn't even show up on level 2. They can hide 150,000. So hide 150,000, only show 50,000. So now you have the illusion that there is more demand than there is supply. And which makes us think that, oh, well, now price has to go up from here. But in the background, they're hiding 150,000 shares that they're selling, which will force prices down. So theoretically, level 2, level 3 should show unfilled buy orders and sell orders. But thanks to a simple click of a button, yeah, it's called iceberg. That's right, B-Germ. Level 2 for TradeStation is worthless. Sorry to say it. You said it, not me. It's called an iceberg order. An iceberg order. Right? So there's a button. Any of us could do it, but we don't have the power. Even though I have a hedge fund, I don't have that big of a hedge fund. Like, I don't have that big of a fund to be able to manipulate markets and manipulate people. But if I were Goldman Sachs, I would definitely use that feature. I would definitely use that feature to manipulate perception. It's literally just a checkbox. And I used to use TradeStation when I was teaching over at an old academy I used to teach at. Gosh, half a decade ago now. It's hard to believe. But yeah, that button is right in your order form. Hide order. And you can choose how many shares you hid. It's so ridiculous. Is it unethical? Yeah, probably. Very much so. But if we're talking about unethical behavior, I think we should go into legacy media and ask how much their behavior is unethical. If you think that this is a fair market, if you think that the stock market, which includes influence from media and news, which is the same thing, I guess, everything that influences the stock market. If you think it's fair for you and I, small retail traders and the millions and millions of retail traders in the world, if you think that the playing field is level, you could not be more mistaken. And that's just unfortunate. I wish it were. It is unfortunate, but the playing field is not level. Which is the primary reason why I do not listen to news. I do not. I mean, I look at the news because I want to see, if anything, I want to see what the masses are being influenced to do. Right? I mean, but I'm okay taking the opposite stance of the rest of the world. Right? Everybody's running for the hills. The market's down. I mean, you think about it, 2 weeks ago on Monday. 2 weeks ago on Monday. Oh gosh, I didn't mean to do this earlier. I deleted all my lines, all my zones. That's probably a good thing. But 2 weeks ago on Monday, the market had gapped down another 4% after multiple day after day after day after day. But it gapped down and ran into monthly demand, right? Rally-based rally, and this is flip demand, actually. Rally-based rally at a old area of resistance, breakout to new highs, 26% rally after breaking out. A return to that area is a buy signal, hands down, no question. I'm not even thinking about it. I'm a buyer at that price, right? If I'm, especially if I'm an institution. But what was the media saying at that time? Another 4% down on the Dow due to, in the S&P due to tariff risks and uncertainty. From the very tippity top of the market to the lows on that Monday, the market was down 21.91%. Can you see my data box here? The third line down says minus 21.91. When the market's down more than 20%, what is all over news media? What kind of market are we in when we're down more than 20%? Bear market. More than 20%, bear market territory. Everything's bad. Recession, tariff uncertainty. I mean, that will influence even the most sophisticated of investors to say, I'm out, sell, sell, sell. But this could not be the worst time to sell, right? No, I don't think you missed the boat. I don't think you missed the boat. I mean, we still only recaptured about 60% of the fall from, I mean, well, 50% of the total fall, but 60% of the fall just in this one candle. No, I don't think we missed the boat, but do I think you got the best price? I don't know. It's hard to say. Do I think that prices are coming back down to, 48.73? It doesn't feel like they want to. I mean, other than United Health today, which dragged the Dow down by a lot. Holy schmoly, look at this candle on the daily chart. Down 22%, United Health. That dragged the Dow down the whole day. But look, bank stocks are up 1%. Anytime bank stocks, financials are up, that's bullish. S&P, end of the day up 0.13%. NASDAQ, I'm looking for NDX here. Where's NDX? It's got to be alphabetical, right? That looks like it was flat for the day. NASDAQ futures ended up a little bit higher. S&P ended up about 0.25% higher. So, I mean, overall, the market is feeling like it wants to be more bullish than not. Now, obviously with uncertainty, and we're one tweet away from Lord knows what, right? And so I don't make any, I mean, yes, we're in the business of making predictions because that's what we have to put our money somewhere. And we have to put our money on making predictions. But ultimately, even if we retest these lows, let's go back to the futures for a second. What time is it? Oh my gosh, it's already been an hour. I think that there's a significant amount of demand in this area to support the market for quite some time. I do. And I try not to let my personal bias or feelings get in the way because, gosh, in trading, those will serve you not as good as you would hope, in my experience, right? So yeah, I listen to media because I want to know what the average retail investor is being fed so that I can consider doing the opposite, right? B. Jerome, Corey, great session. You're a great teacher. Oh, thank you so much. I actually can't tell you how much I appreciate that. That's actually a very nice compliment. If I were still 40, I would start again. I don't know why age matters. Age doesn't matter. I'm pretty sure the people in the room that are in their 60s and 70s and 80s would say, hey, we're all still trying to learn here. I just turned 50 in December. So what am I, over the hill? I'm on the backside. I'm on the back nine. Is that what you're telling me? Prime. That's right, Jim. I'm in my prime. Get your Geritol. That's actually probably closer than true than not. I got my glasses for the first time. What is it, about a year and a half, maybe 2 years ago, for like close stuff. How do I look? Do I look smart? But I see really well when these are on really close. But I was always a huge fan. I'm a huge fan. I was always a super bragger. Like I could see all the way at the end of my cul-de-sac. I could see signs, road signs, street signs. I could see the smallest print so far away. And now I was in the back of the room at a event that I was at this weekend for a trading seminar for another company that I built a mentoring program for. And I might have been 7 rows back, just like classroom style seating. And the instructor was like, hey, what's this number? I'm like, I don't know, bro. I got to get up and walk halfway across the room just to see what you're talking about. Like now my long sight is not even good. And I don't know if it's because I spend a lot of time in the studio and it's low light and in front of a screen is probably hurting my eyes, but holy moly, you hit 50 and everything just goes downhill. Jim, have we met before? Teasing. Cataract surgery solves that problem. It's probably true. Yeah, forgetting. I mean, my wife would say, I told you about that. I'm like, no, you didn't. No, you didn't. It wasn't me. I don't know who you told, but it wasn't me. It's probably one of your other friends. Need pills of all. So far, I don't take any pills, so I'm happy about that. I do a parasite cleanse once a year, maybe twice if my wife makes me. And I might need to get glasses that have both long and short-sighted stuff. I have no idea. But anyhow, we're just getting off topic here. But it is the top of the hour, so this is about the time where the train falls off the tracks, as they say. I think I got all the questions in, though. Yeah, I would agree with that, John. Harkonnen, be in a range for a while, no real fuel to go up, then continue. Yeah, I mean, I literally wake up and before I even get out of bed, because I'm not a day trader, I don't rush out of bed to start day trading the early morning hours. I'm a swing trader, so I have the luxury of, even though I'm on the West Coast and my alarm goes off at 6:15, the market opens at 6:30. I don't have to jump up and get in front of the computer, but I always just grab my phone and I say, okay, where the heck are the futures markets this morning? Where's the market going to open? And I literally say, it's anybody's guess. So I'm not surprised. That's why I'm not surprised. Last question. What's the best thing to learn after Iron Condor? Well, B-Germ, it's funny you ask. Stacking Iron Condors. I'm in the thick of it right now, and it's awesome. Stacking Iron Condors throughout the day on 0 DTE SPX options. It's pretty badass, but you can't leave your computer screen. So there's that. I have not applied stacking Iron Condors to swing trading, but that's my next phase. Straddle or strangle. Well, straddles and strangles, John, are a delta hedge to one another. They are a delta hedge to one another. Actually, straddles and strangles they're better in theory than they are in real life, I found. There was a time where straddles and strangles made a big difference when stock prices were a lot lower and volatility around earnings was a lot higher. You used to get 18, 20% moves on stocks all the time, the big high flyer stocks. UNH probably in hindsight would have been a good straddle strangle candidate. I mean, I really think that you need about an 18% move on a stock or more for a straddle or a strangle to pay off. Butterflies, iron butterflies. I mean, what you're asking is, a butterfly says, whoops, butterfly, your risk profile looks like this. So here's your profit and loss graph, right? So if you're profitable or you lose or you break even at this line, butterfly looks like this. So that tells me that price needs to land at a very specific price in order to make money. Never found a lot of value in those. Yeah, broken butterflies are cool, right? Because then you can do things like this. You can say, okay, I'm going to do this and I'll do something like that, right? So a broken call butterfly may look like that, right? Which is cool, Ariel. I like those. So when you have a directional bias, but you want to get a cheaper spread than just a straight vertical spread, a broken, call butterfly would look like that. A broken put butterfly would look like, this, something like that. So they can be powerful. They can be good, but it's basically a bull call or a bear put spread with a little kicker, right? But I like something that's more unbalanced like that or broken than like a standard butterfly because, for the same reasons I don't like horizontal spreads, I don't like butterflies. Oh, you think you're going to know exactly where the stock is going to land? Good luck. Right? Oh, yeah, but if the stock price moves up, you'll make money, right? Well, yeah, not that much relative to your max profit. Yeah, just hold till expiration. The day before expiration, the best case scenario looks like this. 40% of your profit potential, maybe. Otherwise, you got to hold through expiration. And if you hold through expiration, you risk assignment. you will get assigned on something. So never been a huge fan of standard butterflies, iron butterflies, anything, horizontal spreads where you need the stock to land at a specific price. You can try and use max pain and pinning a butterfly all you want. But you know, max pain on the S&P was 5,400 today, and the stock closed at 5,300. I mean, the S&P closed at 5,300, so they're 100 points off. So max pain doesn't work either necessarily. B. Jerem, Corey, you seem to to perfect. Oh, perfect. Oof. Gosh, I tried to. Strategically placed puts and calls. I tried to, yes. And for my credit spreads, which I've been doing a lot more of lately because of the uncertainty, it's just selling put options below current price where I don't think stocks will go because we have a demand zone or a support level blocking price from getting to those puts as a defensive layer, or short call spreads above current price where we have resistance or supply blocking price from getting up to those short strikes. That's been a lot of the stuff that's been working okay today. But with even today's volatility, it's been like I've had some stop outs that I didn't expect. It just happens. That's why we have stops, right? But yeah, I certainly love option trading during this period of time versus stock trading because stock traders are having a very probably difficult time right now. Being very directional versus non-directional. And speaking of which, I thought there was somebody. Oh, maybe that was you, B Germ, who asked the question. Yeah. What can we learn after just simple calls and puts? Learning after, you know, simple calls and puts, debit and credit, sign cards. Yeah, so I would be like, if you're talking about what option strategies to really learn, I would focus 100% of your attention on vertical spreads. 100%. Because whether you're talking bull put, bear call, bull call, bear put, for individual vertical spreads, some directional, some non-directional. When you talk about a butterfly, what you're talking about is a bull call and a bear call on the same stock at the same time, using the same short strike. It's a combination of verticals. An iron condor is a credit spread that has a wide bear call spread and a bull put spread. So vertical spreads are the foundation for everything that you just mentioned. Every strategy you just mentioned are vertical spreads. And combining more than one vertical spread with another. So if you can learn vertical spreads in every way that they breathe and move and evolve, then there's a whole bunch of strategies that you can experiment with. Yeah, Iron Condor on the Russell was great until it wasn't. That's the thing about Iron Condors. Things stay in a range until they don't, right? So right now what we're building, which is really awesome. We've had, I say knock wood, I don't think we had a losing day yet, but we're testing on smaller contracts in real money and larger contracts in paper money is stacking iron condors. So just as the day progresses on options that expire today on the SPX, so no assignment risk of shares, just cash settled, is, you know, you get into a range, and if the price moves towards one end of the range, stack another condor on top of that. And if price violates one of the strikes, roll up and stack another condor on top of that. And it's actually been, it's busy. You can't leave your computer, which is my least favorite thing about it. But I don't know how often I leave this studio anyway, so I might as well have a strategy that gives me defined risk, unbelievable reward. And I don't have to hold the position overnight, which is really a fantastic and very settling feeling in today's environment. So we are building this as a supplemental, possibly a primary strategy in the fund. It's been going really well in the weeks that we've been testing it. Yeah. Selling puts on gold futures has been good too for 0 DTE, very short puts. Yeah, I believe it, especially because gold has been bullish as hell. Holy bullish has gold been. So I could see that. Yep. So, all right. Well, we've got 15 minutes past the top of the hour. I always love spending time here, but it's 9:15 on the East Coast. Could you imagine how many people want to go to bed right now? Or maybe not. Maybe they just want to get to the season premiere of The Last of Us. Maybe they want to watch that. Maybe they want to watch the Beverly Hills Housewives reunion. I have no idea. I don't even know that that exists. Why would I even know that? No idea. No market tomorrow. Crack a beer. There you go. My dinner. I smell dinner in there. It's 6:15. It's dinner time in there. Got your PhD in options. B-Germ, we have a lot more to learn, buddy. But it's fun, though. I mean, you know me. I'm whatever I know, you're gonna find out. So if you're not a member, let me just say this, one shameless plug. Allow me one shameless plug, everybody. One, just one. If you're not a member, there is a promo code Trader60, Trader60, that will get you 60% off the first month subscription or membership. I hate that word, subscription. Membership to TradersArmy Pro membership, which gets you access to all of our trading rooms. There's 8 trading rooms a week, futures, options, crypto, you name it, it's all there. All of our on-demand content on options, simple options, advanced options, you name it, it's all in there. Trader60 will get you 60% off your first month. After that, it's a measly $149 a month. And by the way, I say measly jokingly. If we can't make you $149 a month in trading, then either something's wrong with you or us. So let's if there's something wrong on your end that we can help with, we would love to be able to help. And so yeah, 250 CAD, that's true, Jim. So annual membership is better for that, right, Jim? Because you get even bigger discounts as an annual member. But yeah, we love to be able to help. We love a good challenge. And if you're challenged in your trading or you want to learn more, you're not challenged, you just want to get to the next level and try some option stuff, some new option stuff, get advanced. Let us know. We're here for you guys. Again, Trader60, that's my one-time shameless plug in the entire free every other week Stocks on the Rocks. So Jim, I appreciate you, man. Thank you so much. No better instructor in the country. I've been around a lot of these guys for a while. John, thank you so much. I appreciate that, John. Man, we should probably can I get my wife in here so you guys, I mean, can you say nice things about me besides my instructing? Can I get my wife in here, my kids, all that stuff? That'd be awesome. No? Okay. Yeah, that's asking too much. I get it. Nice hair too. There you go. Nice hair. Nice drum set. Ah, look at that. Nice drum set. All right, you guys, enjoy your weekend. Hey, happy Easter to everybody. And I will see you guys either in the trading rooms or the next Stocks on the Rocks a couple Thursdays from now. And either way, be safe. Let us know what you need. We're happy to help. Be good, you guys. Have a great weekend. Bye.